Good afternoon. I want to thank everyone for logging in today to our webinar, the first of our series of our Back to Basics in regards to self-directed IRA accounts. And hopefully today's presentation is designed really to give you the fundamental understanding of really what a self-directed IRA is, what types of accounts can be self-directed, and then giving a couple of examples really of things that you can do within your account. Now, as we go through the webinar today, if you have any questions for me as we do this live, please type them into the question box. I'll make sure to try to get to as many of those as possible during today's webinar. If you're listening to the recorded version on our YouTube page, you can certainly call or email us following the webinar, and we'd be happy to set a time to have a consultation with you, answer any questions that you have after viewing today's webinar. Just a little bit about myself. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company since 2006. Started out doing handling a lot of individual transactions, people buying and selling real estate, notes, private placements, some of the things we're going to talk about today. Transitioned over the last several years really to spend more time on the business development side, helping more people kind of find out about what self-directed IRAs are and really kind of teach them more about using them. So it's really what today is really an extension of what I've been doing over the last few years. I am a licensed attorney. I don't give any legal advice though for Advanta clients. So we might talk about some legal issues here and there today, and even throughout your time if you're dealing with us at Advanta, but unfortunately we can't give you legal guidance or as far as an opinion. So I'm an attorney by degree, but I don't give any legal advice for Advanta clients, and kind of leads right to our disclaimer that we don't provide any tax or investment advice as well. So at Advanta IRA, we are happy to provide a service. We're happy to get into some of the legal and tax issues and make you aware of potential issues for a transaction that you might be doing. And we'll talk about that a little bit later in today's webinar, become a little bit more apparent. And most importantly, we don't endorse any products or any particular investments, and we're not affiliated with any other company as well. Now, we certainly have partnered up with other companies and individuals in the past who have provided some educational material on our website, or we've worked with their clients doing particular investments, but we never endorse any particular product or a particular company to work with. So it's important that if you're considering self-direction for yourself, to do your due diligence, not only on the people that you're dealing with, but the investment that you're considering as well. Just because it can be held in a self-directed IRA doesn't necessarily make the right investment for you. So if you ever need referrals for an attorney or a tax advisor, financial advisor before entering an investment, we can certainly provide you a list of those individuals. Just a quick note about our company. We've been in the industry for over 15 years. We have over $1 billion in assets under management. And we really try to separate ourselves in two ways. So one is our customer service. We provide an individual account manager for all of our new accounts. You have basically a concierge style relationship where you have a one-on-one contact for anything you need regarding your account. When you call our offices, you're not placed in a queue and getting the next available individual to answer the phone and help you out. You're going to have that one-on-one person on a daily basis to help you out. The other area where we really try to differentiate ourselves is in our education. And today's webinar is simply an extension and another instance of what we do in that regard. So we do a lot of educational seminars and webinars, usually probably at least four, if not more than that, events per month where we are teaching about self-direction, or again, we might be partnering up with another professional in another field on an issue kind of related to self-directed IRAs or real estate investing. So we are big believers in putting as much information out there as possible to help you get your questions answered and make sure you're on the right track as well. So we do a lot of live events. Sometimes it's a lunch and learn in our office. Sometimes it's a webinar just like the one we're doing today. We also have an on-demand center. I mentioned that this webinar is being recorded and that you can go back to our YouTube page. We have a list and basically a library of all of the recorded webinars that we've done. So over the years, again, we've had people talk about tax lien investing and investing in rehab properties, or investing in private notes with your IRA account, or how to do proper due diligence on private placements. All of those events, all those past webinars are archived on our YouTube page. You can go back and listen at any point. And we also obviously have a blog and a website as well with a lot of other good information. So many of you on the call likely have heard of a self-directed IRA account, but for those of you maybe who are new to self-direction or kind of wondering why you hadn't heard about this before, you did. The most common reason is that most IRAs are administered by banks and brokerage firms, and those companies offer you limited investment products. They've made a business decision to hold mutual funds, stocks, bonds, other publicly traded assets. But even though they could allow for alternative assets like what we're going to talk about today, they choose not to. IRS regulations allow for a very broad range of investments and possibilities, but it's up to each custodian to decide what they're willing to hold. And as most individuals, start an IRA maybe with old 401k. You build that up over a number of years. You've been limited all along to mutual funds and stocks, and most people don't come across this unless you're looking for it, or perhaps somebody tells you about it. So that's really, again, the reason most people haven't heard about it is the banks and brokerage firms don't have any incentive to tell you about the alternatives to the products that they offer. Why people choose to self-direct over the years, talking with countless individuals, most people fall into one or more of the following buckets. For some individuals, an IRA is a tax-deferred entity or possibly tax-free if you're using a Roth IRA, which we'll cover in just a moment. So for a lot of individuals who are choosing to self-direct, they're finding an investment that they don't want to have to pay any taxes on now from the returns they're going to get from that investment. So they choose instead to make that investment inside of the IRA. So they utilize the tax benefits that the IRA offers to make an investment. For some individuals, it's simply a new source of capital. So they are people who invest in, say, startup companies. That's their kind of what their niche is and what they like to invest in. The IRA is simply providing them another way and additional monies they can use to invest in the next startup they find, or maybe if they're a real estate investor and a property becomes available down the street that they want to take advantage of, the IRA is providing that capital. And certainly, again, another reason in this day and age as well, we're seeing a lot of a little bit of turbulence in the stock market up and down. That makes a lot of people uneasy, especially maybe you've worked for a long time, built up a nice nest egg, and you don't want to see it wiped away like it was back in 2008. Or other times you want to put it in something maybe that you're more secure with, something that you believe in more, and certainly have more control over. So individuals, again, that's a common theme with a lot of clients who are just tired of watching the stock market go up and down and not being able to really have any control over their retirement dollars and have it tied to this market that they really don't understand. So we can talk about self-directed IRAs. The thing that's different about a self-directed IRA as opposed to a brokerage IRA is really the types of assets that you can hold within a self-directed account. Now, the assets we're going to cover here in the next few slides are things that typically you cannot invest in through a brokerage firm IRA account or a bank's IRA. Now, they could allow for it, but they choose not to. Probably the largest category of assets that we hold at Advanta are in the real estate field. When we talk about the word real estate investment or real estate asset, that means so many different things. I joke with people when somebody says I invest in real estate. They got to be more specific than that, because a real estate investment could be anything from a residential single-family home, could be a commercial property that they're renting, could be a fix and flip opportunity, could be investing in the tax lien on a property. Again, if you want to learn more about tax liens, we have several recorded webinars on our YouTube page that deal directly with that. You can buy into duplexes, investing into multifamily syndications. Again, there's so many different things kind of in that when you say I invest in real estate that your IRA could do. Now, we'll go over some of the restrictions in a little bit on what you can do with the real estate. The IRS does have a few rules about what you can and can't do with the assets that you hold in your account. We'll talk about that in just a moment. We also hold a large number of what I would call paper assets, mortgage loans, unsecured notes. A lot of these assets fall in the category really when your IRA, rather than acquiring a hard asset, is maybe lending money to another party. Again, whether you're getting security for that loan in the form of a real estate mortgage or maybe stock in a company, or just doing it on an unsecured basis. So your IRA in this case doesn't own the hard asset of a piece of real estate, the physical property, but owns a piece of paper that is tied to or is collateralized by that piece of real estate. So whether it's an option contract or individuals who are getting a property under contract and then assigning that contract and taking back an assignment fee inside the IRA. A lot of individuals who are in the private lending space with their IRA structure a lot of it as a joint venture opportunity where my IRA is lending money to someone else who's fixing and flipping a property. We're going to share a little bit in the profits as well. Again, as we go through the presentation, if you have any questions, please make sure you get those asked in the chat box as well. So other alternatives other than real estate and notes, LLCs, like a limited liability company, can be formed for a variety of reasons. Individuals who are looking for starting a new company might form an LLC to have that as their business structure. Someone can use an LLC as a way to get what we call checkbook control of their account, basically putting their IRA funds into a structure that allows them to write the checks and make the investments. Or an LLC could just be, 4 to 5 friends who want to invest in the same piece of real estate and pool their money together. So we see a lot of those different types of investments as well. And kind of other alternatives, we see farm animals, private partnerships, precious metals. Lately in the last few years, something that the IRS would never have thought of back in 1975 when they created IRAs was cryptocurrency can be held inside of an IRA account. And another kind of big area where we see a lot of investment is really the private stock. Local community banks, startup companies who are looking for that initial capital might raise money, and because it's privately held stock, again, the banks and brokerage firms won't hold it. And again, that's the kind of the thing that brings all of these assets together, whether it's real estate, whether it's notes, whether it's an LLC, precious metals, is that generally speaking, the brokerage firms and the banks will not hold these assets in an IRA account, but certainly the IRS will let you make that investment. Did have a question pop up and said, can you email us the PDFs of the slides? We can certainly send those out after the webinar is concluded. So we'll make sure we get those out to everyone as well. So when we're considering someone who's considering self-direction, it's important to kind of figure out what kind of plans what kind of monies can I use to self-direct? And the answer is really any type of IRA account, whether it's a traditional or Roth account on an individual basis, whether you own your own business or work for a small business and have either a SEP or a simple IRA. If you have an account at an institution that is an IRA, you certainly can self-direct it. It's a matter of simply taking that step to move the money over into an account with us and then choosing to make that other investment. Other than kind of IRAs, the other accounts we offer at Advanta, solo 401ks, if you're self-employed, if you own your own business and you don't have any employees other than yourself, we have an individual 401k plan that you could establish. And there's certainly any old 401ks. If you worked for an employer for a number of years, whether it's a private company, a local school board, local government, those old 401ks, 403bs, 457 plans, or if you're a federal employee, the thrift savings plans, those can also be self-directed. It's just a matter, again, at that point of taking the step to move that money from that old plan into a self-directed IRA account. The one kind of category of funds that can be restricted to being self-directed would be any current employer money. So if you have a 401k through your current employer, they may not allow you to move that money into a self-directed IRA. You do have to check with the administrator of those plans, and unfortunately, a lot of times, again, they do place restrictions on your ability to move that money. But let's go into a little bit more on some of these accounts, a little more detail. The traditional IRA, probably the most common type of IRA account there is. It's a tax-deferred entity, which means the contributions that you make to a traditional IRA over the years, generally speaking, will give you a tax deduction, which lowers your current tax bill. So you put $6,000 into a traditional IRA in 2019, you get a $6,000 deduction on your tax return. That money is going to grow tax deferred. You're not going to pay taxes as you go. as your investments are made inside the IRA account. But when you do reach retirement age, the money is taxed to you when you pull it out at retirement. One of the biggest reasons that for the traditional IRA is the most common IRA is really that going back to those employer plans, any former 401k, 403b plans, etc., those can be rolled over into a traditional IRA with no tax consequence. So that's going to be the reason why there's so many of these accounts. People who leave jobs and want to get more control over the funds are able to simply choose to do a direct rollover from those accounts as well. Let's see, we have a couple questions again that popped up here. Let me get to those here just before we go to the next slide. Have we seen warnings about loss of 401k balances in a fiscal reshuffling? Obviously, I haven't seen anything in particular. Again, we're not financial advisors, but that's something to obviously consider in what's going on in the general world can certainly impact your 401k account balance. What is the risk of having part of my 401k being confiscated? Just my personal opinion, I don't know that there is a huge risk of that. I mean, obviously, the government can change tax laws and change contribution limits and rules to IRAs. Generally speaking, your IRA and 401k are largely protected from creditors in every state in the nation. You have to check with your individual states and the laws from having creditor protection. That is one thing that most states have for both IRAs and 401ks. From your personal creditors cannot touch your IRA account. Now, when it comes to the federal government, I really try not to make any real predictions on that. Obviously, things can change, but have not seen anything in regards to that. Someone did ask about educational savings account. Yes, in addition to the IRAs that we talk about today, one of the things that we're not going to typically we don't talk about a whole lot, but we also offer health savings and educational accounts as well. Last question before we move on: can my IRA make a gift to my grandson's ESA account? The answer is no. You cannot transfer money from an IRA directly to an ESA. You would have to pull that money out as a distribution and then personally contribute that money to your grandson's ESA. So when you move money between IRAs, which we're going to talk about in a minute, it usually has to go from like account to like account. So getting back on track here with the slides. So the traditional IRA, again, most common type of IRA that we see. Again, anyone who has earned income can contribute, and it's a tax-deferred entity. Now, the converse and kind of to the traditional IRA is a Roth IRA account. These are it was added to the tax code back in 1998, so they're much newer than the traditional IRA, which has been around since 1975. But the Roth IRA, like I said, is kind of the inverse of the traditional. Contributions you make to your Roth, when you put money in, you put that $6,000 contribution in this year to your Roth IRA account, you will not get a tax deduction. So on your personal tax return, it doesn't help you at all for this particular year. But the benefits are that money is going to grow tax deferred like the traditional IRA. So as you invest and reinvest with inside the Roth, you don't pay taxes. And when you pull that money out in retirement, that money comes out to you completely tax free. So it's not a gimmick, not a joke. A Roth IRA is a tax-free entity, which is why if you talk to a CPA or you talk to an advisor, they're always very big and bullish on investing in, if possible, a Roth IRA account, because that tax-free growth is indeed so powerful. So there are some limitations on contributing to a Roth IRA. If your income limit is too high, you may not be able to make direct contributions. That's something, again, to check with your tax advisor. Maybe call us after get in touch with us after the call, and we can certainly go over what those limitations are. So the other accounts we offer at Advanta, so I would say probably 90+% of the accounts we have at Advanta are either a traditional or a Roth IRA, but we do offer, again, a couple of them different accounts, retirement accounts that are well suited for people who are self-employed. We have the SEP IRA, the Simple IRA, and the Solo 401k. So if you're a sole proprietor, a business owner, independent contractor, you could potentially have one of these accounts. They're all, generally speaking, tax deferred, like the traditional IRA, meaning that you get contributions, you get deductions for the contributions you make. But the annual limits, the amounts you're allowed to put into those accounts on a yearly basis, are much larger than the traditional IRA. For a traditional IRA, you're limited to $6,000 or $7,000 in contributions in a given year. But for instance, with a SEP IRA for 2019, you can put upwards of $56,000 a year. There's a formula involved. Again, it's a good thing to talk with a tax advisor about to get their guidance on what you can establish. But the SEP and the simple IRA simply allow for a much larger contribution than does the regular IRA account. We also do offer the solo 401k plan. So for anyone who's been involved in a 401k plan through your employer knows that you can defer some of your salary on an annual basis and have the company do a profit sharing match. But when it's just you and you work for yourself and you own the business, you can contribute both as the employee and the employer, and you can get to that same $56,000 maximum contribution limit like the SEP IRA. It's just a little bit different formula involved for doing the solo K as opposed to the SEP IRA. Now, the one thing that the 401k does offer that the SEP and the simples do not is the ability to make part of your annual contribution to a solo K into a Roth component. So we talk about how great the tax-free benefits are that the Roth IRA offers. It is possible to have a Roth 401k as well. And again, that's something we're not going to get into in the details of this seminar, but I'm more than happy to talk with anyone individually afterwards. So with these accounts, with these employer-based accounts that we offer, generally speaking, most of the SEPs and the 401ks and the simples that we open are situations where the company, the individual, does not have any employees, or certainly any employees that would qualify. Now, if you're looking to establish a SEP, a simple, or a solo 401k, and you have employees, you are still allowed to have those plans and exclude some of your employees from even participating. If your employees are under 21, they do not you can have them not qualify. Those who work less than 1,000 hours a year for you with a solo 401k, if they're under that threshold, you can still have a solo K and not have to provide for them. And also for a SEP and a simple, if someone has not worked for you for either 3 years for a SEP or 2 years for a simple, you have the ability to continue contributing for yourself to your SEP or simple until you have employees who reach that threshold, at which point you do have to contribute to them like you contribute for yourself. Let's see, we had another question come up. Will the income earned using Roth IRA, will this income be taxable? Again, with the Roth IRA, the benefit is that money comes back to you completely tax-free. So as you're growing that money inside the Roth IRA itself doesn't pay tax. And when you pull that money out in retirement, it comes out to you tax-free as well. So that is the benefit using the Roth IRA, is it's going to be completely taxable to you when you reach retirement age. So again, we have traditional IRAs, Roth IRAs, the most common types of accounts at Advanta. We also offer the SEP, simple, and 401k. So the question a lot of times when we're talking to an individual looking to start with self-directed IRAs and get that money moving is exactly, how do I move it? How do I get that money from my current custodian over into a self-directed IRA account? Typically, there's one of two ways individuals will move money from an existing custodian to us, and that's either by doing a transfer or a direct rollover. Now, both transfers and direct rollovers are non-taxable events. They can be done in partial amounts, so you do not have to move your entire brokerage account over to Advanta. If you come across a piece of real estate or private stock that you want to invest in, you are permitted to do partial transfers. But the only difference really between a transfer and a direct rollover is where that money is starting and how it's getting to us. So if you have an existing IRA, like a traditional or a Roth IRA or a SEP IRA with a brokerage firm, to get that money moved to Advanta, it's considered a transfer. It's a trustee-to-trustee movement of money. We send the request to your brokerage firm to have them do that direct transfer. And again, that's non-taxable. It can be done unlimited amount of times, and can be done in partial amounts as well. A direct rollover is simply when you're moving money from that former employer's plan, the old 401k, the old 403b, maybe the thrift savings plan. You would initiate that process with your administrator, and they then send the funds directly from your old 401k, for instance, to your self-directed IRA. Again, it's a non-taxable movement of money because you do not touch the funds, and that's the key thing to understand. When you're doing a transfer or a direct rollover, you as the account owner are never in possession of that money, and therefore it's not taxable to you in order to move that money around. And again, as long as you're not touching the funds, you can move money between those accounts as often if you'd like. So a question pops up, said IRS only allows one rollover per year to a self-directed IRA, correct? Can you go over that legal distinction? So yes, and exactly what we're talking about here with a direct rollover and a transfer, those are allowed unlimited times because you never touch the money. So you can move money from one IRA to another as long as you don't touch the money an unlimited amount of times. The once a year restriction only comes into play in situations where you actually do touch the money. So if you take a distribution from your brokerage IRA account into your personal checking account, the IRS will allow you once per year to then in turn move that money back into an IRA within 60 days to avoid any tax consequence. That we call as an indirect rollover. We typically do not recommend people move money in that fashion because it can only be done once per 12 months. But when you're doing a transfer direct rollover, you're never in possession. So there's no restriction on moving that money around. It's only when you take personal possession as a distribution when that issue came up. And it's a great question we had there, and hopefully got that clarified for you. So again, we talk about the types of assets. We covered a lot of these already in the earlier slide. Again, the common thread with the real estate, the notes, the private placements, the syndications, is that brokerage firms will not hold these assets. As I mentioned at the beginning, it's a business decision from the brokerage firm that you have your IRA with the bank you have your IRA with, to choose not to hold that. IRS rules allow for all of these different investments to be held in an IRA, although again, there are a few restrictions we're going to talk about here. But when the IRAs were created back in 1975, IRS said there's only a couple things you cannot do with an IRA account as far as an investment. They said there's two types of investments you cannot make, and there's also certain disqualified persons that your IRA cannot transact with. So again, 1975 was when the IRS laid out and Congress laid out, here are the rules for investing with your IRA account. You cannot buy life insurance or collectibles. So the antiques, artwork, rare coins, things of that nature can be considered a collectible. You cannot purchase that inside of an IRA account, nor can you buy life insurance. So we don't get asked too often by individuals looking to make those investments, but those are the only two investments the IRS said you can't make. No life insurance, no collectibles. There is nowhere to look in the code, in the IRS code, that says you can buy real estate, or you can buy private placements, or you can buy mutual funds. The IRS simply said you can't buy life insurance or collectibles, and also you cannot use your IRA to benefit you or a disqualified person. So the disqualified persons are on the right side of this slide, and the disqualified persons for your IRA include you and your spouse, your parents and grandparents, your children and grandchildren, your son-in-law and daughter-in-law, and then any business or entity that is owned or controlled by one of those individuals as well. So the IRS does not want your IRA, which is its own separate legal entity, from being used to transact with or benefit any disqualified person. So you cannot have your IRA buy or sell an asset to or from a disqualified person. So if you own a piece of rental property personally, you cannot sell it to your IRA account. That would be a prohibited transaction. You can also not lend to or from a disqualified person. So if your son was looking to start his own business and you wanted to have your IRA give him a loan to help get him started, that would be prohibited because he is a disqualified person. When it comes to real estate investments, if you're buying a rental property on the beach or a condo in the mountains, something like that, you cannot live or use that piece of real estate, and neither can any disqualified person. So it's important that when you're using your IRA to invest in real estate, it's got to be strictly from an investment standpoint. It cannot be anything you're looking at using, even for a weekend or two throughout the year. The IRS considers that prohibited. No disqualified person can perform any work on the property as well. And you can't use a third party as an intermediary. So if you wanted to lend your son's business money from your IRA to help get him started, you can't loan money to your friend from your IRA and then have your friend lend back to your son's business. That would also be considered to be prohibited. An interesting note on disqualified persons are that siblings, your brothers and sisters, your aunts and uncles, your cousins, are not under the rules considered disqualified persons. So we've had clients lend money to a brother or sister, buy a property and lease it to one of those individuals as well. That is possible, although we would caution you if you're going to deal with family members who are not disqualified, you still want to probably deal with them on a fair market arm's length basis, so you don't have any IRS scrutiny. So just some quick examples of things that would be prohibited. If your IRA buys a piece of property from your son's disqualified, your IRA is buying it from him, that's prohibited. If your IRA buys a piece of property from a third party but wants to lease it out to your daughter, again, your daughter is disqualified, that's prohibited as well. If your father wants to lend money to you or to your son from his IRA account, that would be prohibited because for your father's IRA, you and your son are both direct lineal descendants and therefore prohibited. Your IRA, if you're buying real estate and you need to hire someone to do the work on the property, you cannot hire any disqualified person or disqualified company to do the work. And again, when you look at these examples, there are situations in which your IRA is really on the opposite side of a transaction from that disqualified person. So in the first example, your IRA is buying and is the buyer from a property, your son as the seller. That's prohibited. Buyer-seller relationship. Or in the second example, your IRA is the landlord and your daughter is the tenant. On the third example, your father's IRA is the lender. You are the borrower. Again, all those examples have a situation where your IRA is on the opposite side of a transaction. Now, it is possible, and kind of the last example down there in the corner, your spouse's IRA, if they bought a piece of real estate, would be prohibited from later selling your IRA a portion of it. So if your spouse buys a property, closes on it, and 6 months later wants to sell a portion to your IRA, you're going to have a situation again where you have your IRA and your spouse's IRA on opposite sides of a transaction and therefore being prohibited. However, you could have partnered at the outset, whereby if you're first come across the property, you want to buy it, your spouse's IRA puts up a percentage of the purchase price, and you put up a percentage of the purchase price from your IRA. You could do a joint purchase at the time of the original transaction, and then split the income and expenses going forward. And we see a number of individuals that do that with their IRA or their spouse's IRA, maybe even their IRA and some of their personal funds. But you definitely want to make sure you do it at the outset of a transaction and know as well what is going on, through the life of that transaction and getting that set up at the outset. I'm happy again to, with some of what we're talking about today, it's really more of a general overview. We can have a much deeper dive and discussion on an individual basis, and I would again encourage you to call our offices to discuss that. So the last portion of the webinar today, I want to go through some case studies and kind of how the process works, what we do at Advanta IRA from an administrative and record keeping standpoint, and also really illustrate as well what the clients, what your responsibilities would be if it was your IRA account that you're looking at investing. For all of our case studies, really the process starts with getting an account open. It takes just a few minutes to get the paperwork completed to get an account opened. We then assist you in getting your account funded by either doing a transfer or direct rollover from another custodian, another account that you have. Then ultimately, it's choosing the investment and working with your account manager at that time to get the paperwork drawn up, showing your IRA as the proper owner, and making sure you have approved of it as well. Now, over the years, my experience has been a lot of the people that we talk to, in one sense, have already started investing or started the investment process where they came across a real estate opportunity, maybe a private real estate fund is being started that they want to get involved in, and then they're told that they could use their IRA to make that investment. So they actually come with step 3 already done. They've already chosen the investment. They just have to come back to us to get the IRA set up. So let's jump into a case study, and we're going to use some of these facts really for all the case studies we have, and just use one individual. John has an old 401k plan and a few IRAs as well, total of 200,000 or so. Again, not comfortable with the stock market, and sees maybe different investment opportunities on a regular basis that he could use that money towards acquiring inside the IRA, and not accomplish the goal of getting his money or at least some of the money out of the stock market, and also B, investing in things maybe he knows a little bit more about or has some more control over. So obviously John's IRA could invest in all the different things we talked about earlier. And when you invest through your IRA account, any income that is generated from that investment has to go back to the IRA account. So if you're buying a rental property, all the rental proceeds must come back into the IRA. If you invest in a private placement that issues monthly or quarterly dividends, those have to come back to your IRA if your IRA is the owner. And as well, any expense related to that investment needs to be paid from the IRA as well. So again, buying a rental property, if the carpet needs to be changed or the inside needs to be painted, your IRA needs to pay a third party to actually perform those services, and we issue the check out of the account. So again, if you think about again your IRA as a separate legal entity from yourself, the money comes into that account, the money goes out of that account as far as the income and expenses are shared. And what we do at Advanta is we will receive and deposit the funds into the IRA. We will pay any bills at the direction of the client. So if John has an expense related to his latest rental or rehab property, he sends us the bill. We do the record keeping to pay that bill at his direction. So we keep track of all those records and do all the administration. He can have his tenants send the rent checks directly to us as well. Again, and most important thing I think to take away a lot of times from a self-directed seminar is that you have to do the due diligence on the investment. So when you're looking to buy a rental property, you're looking at investing in a private placement, it's up to you to make sure you're happy and satisfied with the investment you're making and the structure that it's taking, because that's not something we do at Advanta. Our role, as we said, is make sure the money is moved over properly so that there is no tax consequence. Make sure the investment is titled correctly, and also then do the administration going forward of receiving the money in and out of the account. Now, before we get into the next case study in this first example for John, let me get back to a question we had pop up. Question said, may I transfer monies from individual IRA into a 401k? The answer is yes. If you are looking to do a solo 401k plan, our solo 401k allows for transfers from other traditional IRAs or SEP IRAs into that 401k account. Not all 401k accounts are the same, but our solo K plan does allow for those rollovers or transfers from IRAs into the 401k. The only IRA that cannot be transferred into a solo K plan is a Roth IRA. I'm not sure the IRS or Congress have really clarified why that is the case, but the Roth is the one account that you cannot move in to a 401k. Now, if you have a 401k through your employer, you would need to check with them and see if they allow for transfers of other IRAs into that plan, because some 401k plans do not. But again, the 401k we have here at Advanta certainly does allow for that. So the first case study we'll go through is just buying a rental property and what that process looks like for John. So again, John's first step in really getting this process going is to open up the account with us and start that rollover process from his old 401k. So again, John will open up the account, fill out the paperwork with us, but to initiate the rollover, when you're doing a rollover from a 401k, you do have to contact the administrator of that plan to get that money moved over. So we established the IRA, we'll receive the rollover. Now, John obviously has his account opened and is in control, but he's going to have to tell us what he wants to invest in. So initially, that money rolls over from John's old 401k into his IRA account. That money's going to sit there while we await his direction and telling us what it is that he wants to invest in. So obviously, the benefits John sees in the single-family rental home, he's in more control of that investment, picking the location of the property, the terms. He's going to deal with the tenant himself, the structure. There's no other partners, no other investors around. And again, all the benefits and profits, the rents and any appreciation he might make on a sale, all is going to come back to his IRA and helping to grow his account. So again, it's up to John to find the property. We do not keep a list of investments here at Advanta IRA. We are not going to tell him who he should talk to or suggest any investment. So it's up to him to find that particular property, whether he's working with a realtor, whether he just knocks on doors himself, or just comes upon an opportunity. But when John does identify the property, and says, I want to make this in the investment inside my IRA, it's important that the contract and then ultimately all of the closing documents show that his IRA account is the actual owner on the property. So the contract and all the closing documents need to show Advanta IRA for benefit of John Smith's IRA account as the actual owner of the piece of real estate. So if John put this property in his personal name and used IRA funds to pay for it, that would be a taxable distribution. But again, what we do at Advanta is make sure that this titling is clear, so the IRS ever looks at his IRA account and says you used IRA funds to pay for this property, it's clearly demonstrated that this is an asset of his IRA, and therefore the initial purchase was not taxable to him, and certainly going forward any of the gains as well are not taxable to him as well. So you can see kind of the numbers. I mean, you might obviously vary property to property. The purchase price, $150,000. He gets $2,000 a month gross rent. After paying the average monthly expenses, he's still netting back, roughly 10% or maybe even more back to his IRA, depending on ultimately how many expenses he's had. So the accrued rents, again, come right back to his IRA account, and our role at Advanta will be to receive that rent from this tenant, deposit it to John's account, and then when John has any expense for his property, again, maybe some of the initial work to get the property ready to rent or just the ongoing maintenance, he sends us the check or sends us the bill. We will get that paid out of his account as well. So, and again, talking about real estate, could be rental properties, could be rehabs that individuals are looking to do inside the IRA. So it's really up to the individual person, an account owner, what they feel most comfortable doing. Here's just an example of kind of a rehab property. Again, up to John to find the property. Needs to be clear that the property is being purchased in the name of the IRA, and John's account manager will work with the closing agent, whether it's an attorney or a title company, to make sure the proper wording appears on all the closing documents. As well as when the closing documents are finally prepared, we will send all of those documents to John as well to review and approve. So John's going to look over the HUD statement and the settlement statement. He's going to look over the deed, the title policy, et cetera, make sure he's satisfied, indicate his approval before we ultimately sign the documents and then send the money from his IRA to the title company to consummate the actual purchase. When you're doing a rehab, much like with a rental, you're choosing your tenants. If you're doing a rehab, you're going to need to select your contractors to repair the property. Again, that's not something we do at Advanta, and John would be prohibited as a disqualified person from doing those repairs himself. So once John selects the contractors to repair the property, he'll have them give him an invoice. He will forward that to us. We will then pay that invoices, pay for those repairs outside of the extra cash in John's IRA account. Then hopefully John obviously makes a profit. You can see some examples over there on the right, just some numbers there. Again, the key thing to take away is that there is no tax due at all on the profit John makes. That is all going to come back inside of his IRA account. So the acquisition, the repairs come out of the IRA account. Obviously, all the proceeds from the sale, all of them come back to the IRA. So one thing about rehabs and even rental properties to some extent is understanding that if you're going to buy a piece of real estate inside an IRA, you're going to want to have at least some extra cash available initially for any expense that comes up. Especially if you're doing a rehab, you want to make sure that you have enough cash in the IRA to acquire the property and also to pay for any repairs that you anticipate. The only way you can add money to your IRA later would be to transfer from other existing IRA accounts or make an annual contribution. You cannot just after the fact decide to put personal money into the project if you're running short. So make sure you have enough resources at the outset in order to make that particular property and purchase. See, we had another question come up. Says, does a self-directed IRA earn anything while it is sitting in the account pending an actual investment? The answer is it does not. It does sit in a cash position. So the money is in your, any uninvested cash just sits there. It's FDIC protected, but it is not going to earn anything. So for that reason, if you're looking at, say, buying a piece of real estate, we have people who will transfer over just a few $1,000s initially to have towards an earnest money deposit to secure a property, and then can do a transfer again later for the bulk of the funds. Remember, you can transfer money between IRA accounts as often and whenever you'd like. So if you're building up cash in your account from your tenants paying rent, you can always transfer that back to another custodian. There's no restriction on that. As well as if you need to move money, more money over, for instance, if you're rehabbing a property and you're running short, you can always do another transfer over so you don't have a lot of cash sitting in the account. Another quick question: what is the fees that we charge our clients for what John's looking to do with the real estate purchases here? It's a $50 fee to open the account. It's $145 to go through the real estate closing. Those are both one-time fees, and on an annual basis, it's a flat $295 a year for us to hold this asset in his account. We do not charge anything for receiving and depositing rents or paying any of the bills in the account. So that's the benefit. It's just a flat $295 fee. It's not a percentage of the income that you receive or the total value of the account. Just a flat fee based on the number of assets that you have in the account. Had another question pop up. Can you split or partner with your investment company and your self-directed IRA? And the answer to that question is you can, again, as long as it's done at the outset of the transaction. So looking at the case study that we have up right now, if John wanted to buy this property to rehab and use some IRA funds and some money from his investment company, he would have to identify prior to the purchase what percentage his IRA is going to own and what percentage his investment company is going to own. And if he does that, he could structure it as a partnering situation. And going forward, any income that's generated from that property would be split between his IRA and his investment company, as well as any expense. So if you're going to split or partner, you have to make sure that the income and expenses are shared in proportion to that ownership. So the answer to your question is yes, you can partner, but again, it does have to be at the outset of the transaction. If John were to buy this property initially in the IRA and then later decide he needed to infuse capital from his investment company, he would not be able to do so after the fact, because at that point his IRA would be having to sell a portion to the investment company. Again, that's different than actually having a partner at the outset. All right, so move on to our next case study. So just remember, if you own buying real estate in IRA, the IRA has to pay for its expenses and receive all rents as well. The IRA owner is responsible for finding the tenants, finding the contractors, the maintenance, and then also making sure he doesn't do anything prohibited, like doing any of that work himself. We've had many clients hire property managers when it comes to real estate to help them keep hands off. But that being said, I think with a good understanding of the rules and knowing as well that you can always contact us with questions, most people are able to do a lot of this themselves and have, again, just making sure the funds flow in and out of the IRA directly. So another case study, we talked about private lending as being an option. So in this case, John, rather than going out and finding a rental property or finding a property to rehab, where he again is going to have to deal with contractors and tenants, John meets Andrea, who's looking more for someone to joint venture with, and basically looking for capital for her next project. She needs $100,000 towards the purchase and rehab of a property. John can then have his IRA simply be her private lender and basically be the bank for Andrea. So instead of Andrea going to a financial institution and filling out loan documents, her and John can just arrange for his IRA to provide the capital that she needs. And when Andrea makes payments back, rather than satisfying a note or mortgage to a bank, she will just have to satisfy and pay back John's IRA account. So Andrea is still going to sign a note. She's still going to sign a mortgage. The only difference is the lender, instead of being Bank of America or Wells Fargo, is just simply going to be John's IRA account. That Advanta IRA for benefit of John's IRA will be the lender. Now, when it comes to the terms, if you're lending money from your IRA, the terms, the loan amount, the interest rate, et cetera, all those terms are between you and your borrower. So when it comes to private lending, usually we see some more interesting things than you would see, obviously, from a bank. A bank is not going to do typically a joint venturing agreement where they lend you money and wait for a percentage of profits. And that's not their business model. But in this case, John could certainly lend money to Andrea for her rehab, and he could take back a stated just a flat interest rate, or as in this case, John asked for a portion of the profits upon the sale of the property. So his IRA is going to get 6% interest while the loan is outstanding, and he's going to get a third of any profits over and above the amount he's lent to Andrea during the course of that deal. So he does get a first mortgage on the property, so he's got collateral for that loan. If Andrea doesn't pay him back, he at least would be able to foreclose. Again, at Advanta, and even though I'm an attorney, we don't do any legal work, so John would need to have an attorney or someone else draft the loan paperwork and the loan documents. And again, John will be involved in approving that as well. Our role at Advanta will be to review the note, review the mortgage, make sure it's properly titled, and then at that point, make sure John has approved it as well. So John will need to look through the note, look through the mortgage, make sure he's satisfied with all the legalese and terms that are in there. When Andrea, uses John's money, then there's a real estate closing for her to buy the property, and 4 months later, she's ready to sell it. She's going to net after closing 130 grand. So the payoff of John's IRA will be 1/3 of those profits, which are 30 grand, plus the 4 months of interest that the loan was outstanding. So his IRA ends up returning roughly $12,000 from this investment by doing a joint venture arrangement with Andrea on the particular real estate deal. I had another question pop up here. Would the property purchase in the name of the IRA be considered a personal mortgage loan? I believe that's what the question here. No, it's not. It's not a loan from the IRA account. It is the IRA itself as its own entity buying the particular asset. So your IRA as its own entity is purchasing the property. It's not a loan that you have to pay back. So it's your IRA simply is a cash buyer buying a piece of real estate. Let's see. And the question was if additional financing is if there ever is additional financing needed, if you don't have enough cash for the actual deal, it may be possible to either bring in another partner with capital or get what's called a non-recourse loan. That's a little bit different subject that we're not going to get into today, but it is possible to borrow money or have your IRA, I should say, borrow money, but it has to be non-recourse, meaning that the bank or the lender is only taking the property as collateral. They cannot come after you, and you cannot personally guarantee that loan. For that reason, we don't see many real estate transactions where there is financing involved because it can be difficult to get that kind of loan. There are a couple of national lenders who do lend loans to IRAs, but they're typically looking for 30 to 40% down and a minimum loan amount of 50 grand. So for the most part, if you're running short on capital, a lot of times it's a situation where you might look to bring in another partner. And again, another question we have pop up said, can you use your self-directed IRA in a joint venture in the case study 2 scenario? So if you're looking to rehab a property, yes, absolutely. We've seen many people do that where your IRA is put into a deal along with another individual or maybe a couple other investors to rehab a house. So let's say you have 4 individuals and everybody needs to put in 50 grand to buy the property to get it rehabbed. Your IRA certainly could step in for that $50,000 and make that loan. Let me see, we have one moment here. I'll look up some other questions. So you purchase your investment in your personal name, and you split and allow the self-directed IRA work, meaning, of course, the books. So I'm just looking at that question. So if you're splitting your a purchase with your IRA and yourself personally, you do have to make sure that the books, we will certainly do all the record keeping for the IRA, receiving all the income, but on a personal side, obviously you need to make sure that you're properly documenting that income that you get back into your account. So that could be, again, sometimes we see situations where partner people, you do use an LLC as the way to do it to help keep some of the records. But again, we will always do the record keeping for the particular IRA account and have a clear documentation of all the income and expenses. Since Advanta controls rents and expenses, does or Advanta hire a property manager to collect rents and pay expenses? We do not. Again, that is completely up to you as the account owner to decide if you want to hire a property manager. Not many of our clients will deal with their tenants directly and deal with their contractors directly, and simply request money from us when they have a bill to be paid, or direct tenants to send the income to us. So we will not hire a property manager. That is up to you to decide if you want to do so. Again, as long as that person is not disqualified, that's possible. Question is, does the IRA need to get a tax ID number? No, it does not. So if your IRA is buying and selling real estate, you do not need to get a separate tax ID number. For buying the property, you would use our trust tax ID number for that investment. Two questions: can you use the IRA money as a down payment and get a loan? I just mentioned that briefly, that it is possible for your IRA to put the money as the down payment, but if you go to get a loan, it does have to be a non-recourse loan, meaning again that the lender is lending money to the IRA account without the benefit of your personal guarantee. And that lack of personal guarantee a lot of times is what makes it very difficult to get that loan. It is possible, we just do not see it done very often. It says, can you partner with another person? Yes, absolutely. You can partner with anyone, even disqualified persons, as long as it's set up as a partnership at the outset. Question is, if there's a lawsuit that came up on the real estate investment, can they attach the IRA? Yes, if there's a lawsuit that arises from your ownership of a property inside your IRA, they could potentially sue your IRA account for that investment and for their claims. So it's important, if you're buying property in an IRA, use insurance. Some clients, properly cover their property with property insurance, or they use an LLC or a private trust as well to help protect the title. And that'll be something we're going to discuss in our Back to Basics 4, which will be towards the end of the month. And we talk about checkbook control, there's ways to use an LLC to do that as well. All right, let's move on to the final case study here. Investing in a private placement. So again, private placements can be anything from private real estate syndications, private startup companies, private bank stock. So the investment works a little bit different. Rather than in this case, John going out and finding tenants or going out and finding investors, he's going to place his money into somebody else's company. In this case, Randy, who is buying and remodeling an apartment complex. So Randy is probably raising, a couple $1 million worth of capital to acquire that asset and get it remodeled. John is simply going to be one of several investors in that particular partnership. Rather than have John enter into a contract to buy the property, Randy's going to give John a subscription document, basically an application to subscribe and have his IRA become an owner in Randy's LLC. And there's usually a prospectus attached to that will detail kind of what Randy is expecting the project to produce. So John needs to review the subscription documents, review the prospectus for the investment, and determine really if this is something he wants to do. In this case, if it's a multi-family piece of real estate, the benefit for John is that he can simply make this investment in his IRA account, sit back. He doesn't have to find the tenants, worry about the maintenance. That's something that Randy and his team are going to do. And then at the end of the month, they're going to simply send a check back to all of their investors for their portion of the income. So I've had we have a client here at Advanta refers to it as mailbox money. He doesn't have to worry about the tenants, doesn't have to worry about a vacancy in one unit affecting really his overall return. And there's a professional property manager in place. So again, our role at Advanta, when John decides he wants to invest in this private placement, is making sure that the subscriber is Advanta IRA for benefit of John Smith's IRA account. The tax ID number, again, we had that question come up a minute ago, is our trust tax ID number, not his social. So any income that is reported to the IRS from the partnership is being reported back to our trust tax ID and to his IRA account. So again, our role will be to sign the subscription documents, send the money out of John's account to make that investment. Again, it's up to John to review and approve it. And then in the future, the dividends, the profit splits that the partnership spits off each month or each quarter, that money has to come back to John's IRA account. So all those proceeds coming back in with no tax consequence to John at all. We talk about people who are looking to raise capital. If you're someone listening on the call who may be looking to use IRAs as a capital raising source, IRAs are good because they can be from a repeat investor, somebody who's already investing with you personally may simply decide to do an additional investment when they find out they can use their IRA account to make that investment again, because it's not something they had thought about or thought to ask. Also, IRAs, a lot of individuals who have money in their retirement accounts, they still have 10, 15, 20 years, maybe even longer, that they're really not going to be expecting to use that money. So they're okay locking it up in a 5 to 7 or 10-year investment, depending obviously on the overall rates of return. They don't need that money right away, potentially like they would with a savings account. So a lot of the last place people will typically touch will be an IRA or a 401k account in the event of an emergency. So a lot of individuals may be willing to part with that money for a longer period of time. There's also no outside approval needed. So if you're looking to raise capital, instead of going to a bank and going through their laundry list of things that are needed in order to borrow money from them, with an IRA, you're simply making that connection with one individual and having them give you their approval. And hopefully, obviously, you're offering better returns if you're raising capital than IRAs that are sitting in a money market, a CD, or obviously people who just want to get out of the stock market in general. Um, just the last slide here, why Advanta IRA? Again, we handle all the record keeping and custodial functions for your IRA. We illustrated that in the case studies today, that we will make sure your investments are properly titled. We will make sure that money gets moved from your other custodian to us on a tax-free basis, and also make sure that the investment are done correctly, so that it also remains tax favored back to your IRA account. We don't have a lengthy approval process for the paperwork. Our role, again, is to make sure that your IRA is properly listed on whatever investment documents you're making, whether that's the real estate contract, a note and mortgage, or a private placement subscription document. We're not going to review it for suitability, simply making sure your IRA is properly listed on the documents. Again, we have private account managers, that one-on-one customer service. We use DocuSign as well to make things as quick and easy as possible. And try to do things, in a streamlined process. We are really good, and my, I guess, a little bit biased opinion, but really good at making sure people understand what they're investing in, and keeping the client involved every step of the way, as well, and being a resource. We have a lot of clients who call us even after they've purchased an asset or two, and have been with us for a couple of years. Will call us to ask questions and get our thoughts. We're always more than happy to help out in that regard. So again, here's my information on the webinar. I'm going to go have a couple more questions that popped up. I'll try to hit and answer those quickly here, and we'll end the webinar. Let me see. Someone said, "Is DocuSign a good company to invest in?" Yesterday, it's a good question. Not sure on that one. So maybe you purchase your investment in your personal name and then you split. I think we did cover that question as well. Again, if you're going to buy property, both with the IRA and personally, you will have to split the income between your IRA and yourself, and we will keep track certainly of the IRA's portion. What is there any backing of Advanta? How is Advanta sound? As far as our backing, Advanta, we act as the administrator of the accounts. The IRA custodian is Mainstar Trust, which is a non-depository trust institution that is based in Kansas, the state of Kansas, and subject to Kansas state banking regulators. We do maintain an errors and omissions policy, as well as a fidelity bond in excess of $2 million per account. So if there's a mistake that we make on our part, your IRA is insured. If there was any employee theft or anything in regard to that way as well, we have that fidelity bond of, again, up to $2 million per account, protect you there. That being said, again, if you're investing in real estate or you're investing in other types of private placements and alternative assets, you do want to make sure that those investments are adequately insured as well on an ongoing basis. But that's going to conclude our webinar today. I want to appreciate everyone again for logging in and calling in. Or if you're watching the recording, thank you for your time as well. My contact information is on this last slide. Please don't hesitate to reach out with any questions you have about a potential investment, or if it's just general questions on IRAs. We're more than happy to assist you. And don't miss, again, this was Back to Basics Part 1. We have Back to Basics Parts 2, 3, and 4 coming up the next few weeks. So hopefully have you all sign up and be on a lot of those as well. This time, I'll conclude the webinar, and thank you again for attending.